UnitedHealth Group, trading under ticker UNH, is currently priced at $599.47 per share, reflecting a 16.4% increase over the past 5 days and a 23% increase over the last month, even as the broader market faces tariff war concerns. Now, UNH's strength lies in its domestic-focused business model. Unlike manufacturers or tech firms, UnitedHealth isn't affected by tariffs. It doesn't rely on global supply chains or imports physical goods. Its operations, well, they're firmly rooted in the domestic healthcare system, making it largely immune to international trade disruptions. In 2024, UnitedHealth reported revenues of $400.3 billion, an 8% increase year over year. However, net income, well, that declined 36% to $14.4 billion, impacted by rising medical costs and a significant cyber attack earlier in the year. Now, UnitedHealth Group's medical care ratio, otherwise known as MCR, which shows how much of the money they collect from customers is spent on medical care, went up from 83.2% in 2023 to 85.5% in 2024. The biggest reason for the increase was a cut in Medicare funding by the government, which reduced the company's revenue. Other factors like changes in patient mix and rising drug costs also played a role. The cyber attack also had a significant financial impact, with nearly $2.2 billion in direct response costs and an additional $867 million in lost revenue. Looking at the cash flow statement, free cash flow dropped from $25.7 billion in 2023 to $20.7 billion in 2024, marking a 19.4% year-over-year decline. And the decline in free cash flow was primarily due to increased capital expenditures and higher medical costs, including impacts from Medicare funding reductions and Medicaid enrollment shifts, in addition to the lost revenues from the cyber attack mentioned earlier. Despite this decrease, UnitedHealth Group maintained strong operating cash flows, reporting $24.2 billion in 2024, which was 1.6 times its net income. And for the future, well, they project 2025 revenues between $450 and $455 billion, with adjusted earnings per share ranging from $29.50 to $30 per share. In terms of their valuation, the current PE ratio is 38.65, and the forward PE ratio, that's 20.16. So the drop from 38.65 to 20.16 means that the market is pricing in a strong earnings rebound, likely reflecting UnitedHealth's recovery from the Change Healthcare cyber attack and renewed operational strength. If the company hits or beats those earnings forecasts, it could be a solid investment, especially in uncertain times like a tariff war, where the healthcare system is generally more resilient. If earnings don't improve as expected though, the high trailing PE could mean the stock is overpriced. UnitedHealth Group has increased its dividend for 16 consecutive years, with a strong 5-year CAGR of 16.1% and a 10-year CAGR of 21.4%. As of 2025, it pays an annual dividend of $8.40 a share, with a yield of roughly 1.68% and a payout ratio of 54.2%. This consistent growth and balanced payout make it a reliable income stock with strong long-term value potential, especially for those who like to invest in dividend stocks. And analysts predict the stock to trade at an average share price of $633.80, with a low end of $518.76 and a high end of $700. Currently, it's at $599.47 a share, so still below the average estimate. Recommendations, well, they're leaning strongly towards buys, with a few strong buys in the mix. The latest rating comes from Mizuho Bank, which maintained their overweight rating as of April 9, 2025. The bottom line, UnitedHealth has a strong business, a strong outlook, and still has room to run. The healthcare industry has remained stable during this tariff war, and I believe it'll continue to do so until the tensions cool off. As that concludes the video, please don't forget to leave a like, subscribe to the channel, and comment below if you'll be adding UnitedHealth to your portfolio. Thanks for watching, and I'll see you in the next one.